So, 2, 3 subscribers wrote to me in the recent past saying that they want to learn how to take a positional trade on a weekly chart, or they just want to trade the weekly charts. They don't have time for the daily because during the week they are busy, and they have taken a decision that they will only take positional trades. They have also taken a decision that they will only trade the weekly charts. So they were asking me, how do we apply what I teach to the weekly charts? Can we use the same points system that I discussed on the daily chart, the blue, green, red, the 10 candles, the 4 points? So to answer that question, I am making this video. First, let us understand the difference between swing and positional trading. I think I must have discussed this before, but it is worth repeating. Okay. So the primary difference between swing and positional trading is the fundamentals. In positional trading, the stock has to be fundamentally strong. In swing trading, I give less weightage to the fundamentals. The better the fundamentals, the more powerful is that swing trade. But generally, in swing trading, I give less weightage to the fundamentals because I'm trying to catch the upward momentum. Remember Chennai Petroleum? I bought it on 15th of July 2024. The stock shot up 20% in couple of days. At that time, it had negative EPS growth. You can go back and check the fundamentals. So the point I'm trying to make is the main difference between swing and positional is the fundamentals. In positional, it's mandatory that the stock has to be fundamentally strong. It should meet majority of our fundamental eligibility criteria in our fundamental analysis. Swing trade, that is not mandatory, okay, because we are trying to look at stocks that are comparatively and technically strong. And we only take swing trades when the market is in a confirmed uptrend. When the market is in uptrend under pressure, rally attempt or downtrend, we do not take a swing trade, just to reduce the level of risk that we are taking in our trading strategy. Okay. Next, in swing trading, the objective is to get a double-digit return in 2 to 4 weeks. Double-digit return means anything which is 10% and above in 2 to 4 weeks time. That much return is good enough in a swing trade where your position size is controlled. You don't take very high position size on swing trade because you are buying a stock that could be fundamentally weak. In the case of positional, there is no specific target because the stock is showing fundamental strength and the fundamentals could improve. So we don't keep a specific target. We might do partial selling, right? We might sell a portion of our position, but not all, because since the stock is showing fundamental strength, we might want to hold on to at least a part of our position. So there is no specific target. And the time period could be 6 to 24 months. Remember, from base 1 to base 5, that could be a period of 18 to 24 months. That is what is being mentioned here. So there is, for in positional trades, the holding period is 6 to 24 months if you latch on to a good stock. In swing trading, the time horizon is 2 to 4 weeks. Okay, this is what I personally follow. If you look at some of the trades that I took in November, the videos are there on my YouTube channel. At that time, the regulation was not there. I could discuss stocks. But now, after that regulation came where they say that I can only discuss stocks with 3-month-old data. After that, I have not been discussing stocks. But if you see some of the stocks like Dixon, Zomato, which I bought back in November, all of them were fundamentally strong stocks. All of them were positional trades because at that time, the market was in a rally attempt. In a rally attempt, I don't take a swing trade. Okay. In a swing trade, I might want to hold on to the stock as long as it is above the 21-day exponential moving average. And in positional trading, I want to hold on to a stock or at least some portion of my holding as long as the stock remains above the 50-day simple moving average. Okay. This is the difference between swing trading and positional trading. Now, yet let's say that you are working at a 9 to 5 job and you don't have time. You only want to look at charts or markets on a weekend. Okay. And you only want to do positional trading. Number one, I congratulate you for taking that decision because positional trading is real trading. In swing trading, we are just trying to catch the upward momentum, right? So there is risk involved. So whenever I personally go into a swing trade, even if the market is in a confirmed uptrend, I go slow. I control my position size. But in positional trading, I try to get as much stock as possible while controlling my position size. I don't want to exceed my position size by too much. My normal position size is 6.25%. Sometimes I might take one and a half times or twice my normal position size. That would be high position size for me. But that only comes if the trade itself is a positional trade. Okay. So I confidently take a positional trade, but I'm cautiously taking a swing trade because of the fundamental characteristics of the company. So I congratulate you for taking that decision. The moment you say that I only want to do positional trading, you're automatically eliminating all of the risk that comes with swing trading. Okay. This is what William O'Neill did. William O'Neill never took a swing trade. In his entire like 4 decade career, he bought only one stock that was fundamentally weak. Imagine in 40-year career, bought only one stock which was fundamentally weak. So you are in line with what William O'Neill did in his career. So number one, congratulations. The fact that you have decided that you only want to take positional trading automatically reduces a lot of risk, provided you know what fundamental characteristics to look for, which you can learn on this channel. So that's point number one. Point number two, where you are saying that you only want to trade weekly charts and you don't want to look at the market during the week, that is where the problem comes. I will tell you why that problem comes. Because let's say you have a filter, okay, like what I created on my YouTube channel and explained to you my stock filters. So go to my videos. In my videos, just right here in the search, write stock filters, or you go to the video description of this video, you will find that video. Okay. See this stock filters video, this particular video. Okay. This particular thumbnail video, if you watch, you will learn how to create this filter. Yeah, have a look at this. Okay. So there are 3 market Smith rating filters. Then there are 8 technical filters. These are a combination of liquidity and technical filters. Then there are 2 fundamental filters, sales and EPS growth. Okay, so this is a classic positional trading filter. Okay, so if I apply this filter, currently, if you see, there are very few stocks less than 25. Okay, let me click here. Yeah, see, only 22 stocks. Now, as I told you earlier, just because a stock comes in this filter doesn't mean that I'm going to buy the stock. This is the starting point. Okay. And I cannot discuss individual stocks because there are regulations in India, but this is the starting point. Coming back to this slide. Yeah. So first step is to create that filter. Now, what I personally do is I look at that filter, the stocks coming in that filter daily. You are saying that you want to look at the stocks in that filter on a weekly basis. There is a problem there. Let's say on a Monday, a stock enters that filter, okay, and the stock actually goes into a stage 2 confirmed uptrend and enters that filter on a Monday. And by the time it's Friday, the stock has already broken out of the base. And you come on a Saturday after finishing all your work, you come on a Saturday and you look at stocks which are forming bases. But what about those stocks which broke out during that week? You understand what I'm saying? Last weekend, when you did the filtering, the stock was not available in your filter because it was not in a confirmed uptrend. But what if on a Monday it came into a stage 2 confirmed uptrend? The blue, green, red condition got satisfied. But Thursday, Friday, the stock had already broken out of the base and you missed that opportunity. Okay. Remember, William O'Neill was a positional trader. He only used to buy fundamentally strong companies, but he used to watch the market on a daily basis. Okay. So, which means if you want to trade the weekly charts, go ahead and trade the weekly charts. Okay. But you have to scan the market daily because you don't want to miss out on opportunities. You don't want the stocks to break out and then you are checking and wondering, okay, how did I miss this stock? Okay. So you have to find time on a daily basis, Monday to Friday, to at least go through all the stocks showing up in that filter and look at their weekly chart. Now, weekly chart becomes very simple because when you open MarketSmith, okay, the green dotted line is already there. The pivot point is already there. Pivot point is the buy point. Okay. So you already know what is your buy point. You already know what position size you want to take. You already know how to manage the trade based on the 50-day simple moving average and the fundamentals. You already know the criteria. There's nothing else to do. You don't need to learn cup with handle. You don't need to learn double bottoms. You don't need to learn flat base. You don't need to learn high tide flag, power play. Everything is already mentioned in the MarketSmith chart. The buy point is actually printed in green dotted line. You don't have to do anything. The only thing you have to do is to scan, put that filter and scan the market on a daily basis. Now, don't tell me that you don't have time. Do you have time to watch IPL cricket matches? Yes. Do you have time to watch stand-up comedy? Yes. Do you have time to watch comedy shows, movies, Netflix? Yes. So don't tell me that you don't have 10 to 15 minutes a day to scan through all the stocks and just look at their weekly chart. Okay, it takes less than 10 minutes a day. Okay, especially when the market is weak, there are hardly any stocks in that filter. And even when the market is strong, there are very few stocks that are fundamentally strong, which qualify as a positional trade. So you might not end up taking too many trades in a particular year, maybe one trade a week in a year, even that is too large, maybe 25 to 50 trades in a year, good with good position size, high quality stock setups, high quality base. Okay. So you have to check the market every single day. You have to scan it every single day to notice, is there any stock that is coming in the filter that was not there yesterday? Okay. It will come with the buy point marked on the chart in MarketSmith. That is the value that MarketSmith brings to the table. They tell you what to buy, they tell you where to buy, they tell you at what price to buy. They don't tell you the position size, but they also tell you the base count. I mean, what else you need? They also tell you the market conditions. So you know in what market condition to take a positional trade. There is nothing left to chance. All you have to do is to filter on a daily basis, identify the stock, decide your position size, and buy at the proper pivot point marked by MarketSmith. So it's really about selection and elimination. Okay. The more stocks you stay away from, the better it is for your trading. The more selective you are, the better it is for your trading, because that's what positional trading is all about. Position sizing is all about. Okay. So you can take trades on the weekly chart. You don't need to learn VCP. You don't need to learn Mark Minervini's strategy. That is applicable only on the daily time frame. That 10 candle 4 point blue green red, that is only applicable for daily time frame. It is not applicable for weekly time frames. Okay. All of what I discuss on this channel is daily time frame because I follow Mark Minervini's VCP strategy. Okay, Mark Minervini is I consider Mark Minervini and William O'Neill my mentor. Actually, Mark Minervini took the work of William O'Neill and then modified and updated it further. So if you are following Mark Minervini, you are following the latest breakout trading strategy. But since you say that you don't have time during the day to track the daily time frame charts, go ahead and track the weeklies as long as you get minimum 3 weeks of consolidation on the weekly chart. I would consider that as a base. Minimum 3 weeks of consolidation at least we need. I mean, from the top, there should be 3 weeks when the stock goes flat or starts forming a base. 1 or 2 weeks is not enough on the weekly chart. I'm talking about the weekly chart. Okay. Daily, it's different. Daily, we talk about 10 candles. Okay. So, in summary, what do you have to do? Number one, watch the My Stock Filters video. You will learn how to filter stocks on a daily basis. Number two, scan for stocks on a daily basis. Look at their weekly charts on a daily basis. Only those stocks that come up in that filter. You don't want to miss out on good, high quality positional trade setups. Number three, Buy William O'Neill's book. Read that book at least 3 times. Read each chapter at least 3 times, because that is the only book that discusses weekly charts in a proper way. And it will teach you how to use the MarketSmith platform, MarketSmith trading system, what ratings, rankings to look for. Read that book 3 times. You don't need any other book. Okay, William O'Neill was a legend, and if a legend is writing a book, you better pay attention to what he is saying. So watch the My Stock Filters video, master filtering stocks. Number two, find time every day, 5 to 10 minutes to look for stocks on the weekly chart that show up in the filter. Apply what you learn in William O'Neill's book, How to Make Money in Stocks. You don't need to memorize the base types like the ascending base, the cup with handle, double bottom. Just come to the MarketSmith platform chart. The green dotted line is already marked on the chart. You know the buy point. Just be ready to take the trade. Be very selective. Be very strict with your fundamental criteria. The stock has to be strong when it comes to liquidity. It has to be strong when it comes to comparative analysis. Technically, it should be strong. Fundamentally, it should be strong, and market conditions should be favorable. Favorable in a sense, it should not be in a confirmed downtrend. Then you make a decision on what position size you want to enter with, and manage the trade with the 50-day simple moving average and the time frame that I have given here. Do partial selling in between to take some money off the table. That's all you have to do. It's not complicated. You don't have to learn any pattern. The buy point is already marked in the MarketSmith chart. The base count is already told to you in the MarketSmith chart. So if you are buying base number 5, base number 6, you already know you are taking unnecessary risk. That is not a positional trade. And even if you want to take that trade, you have to go in with a small position size. Okay. So that is my little lecture on how you should approach positional trading and weekly charts. You don't need to learn anything extra. Whatever you are learning on this YouTube channel is more than enough. Just read William O'Neill's book 3 times, because there are only weekly charts in that video. There is no daily chart video. There is no daily charts on that in that book. Okay. So master those weekly charts. And when you see something similar occurring on the MarketSmith chart, which matches with what you see in the book or what you learned in the book, take the trade. Okay. Thank you so much.